Hello, investors and traders, and welcome to the weekly market report. I'm AJMonte, Chief Market Strategist with Sticky Trades. And before we get into the charts to talk about this exciting week, I want to highlight the 7-point trading checklist, which is something that I often talk about, especially on the webinars with our members. Taking a look at that, and this is available to all members on the member page, by the way, you can see that I have 7 points that start off with the type of candle. And I'll pay very close attention to that because as I go to the charts, I'm going to be showing you some of the candles that I have listed here. I also pay very close attention to volume because that is actually a leading indicator, not a lagging indicator. The divergence from the 20-period moving average is something that we cannot ignore, especially right now as the markets are rallying over this past couple of weeks. And gaps, which I've been talking about for the past 3 weeks, also get weighed into the equation. Now, as we get to the bottom of this checklist, you can see that the stochastics oscillator and the CCI, which is the commodity channel index, my absolute most favorite, is something that I pay very close attention to. And then the role reversal, which are key support and resistance areas that make a big difference with regard to how you defend your position and using risk management technique. Now, if we go to the charts looking at the DIA, which is the Dow Jones Industrial Average ETF, looking at the weekly chart. Now, I'm starting with the weekly chart, and then I will zoom into the daily chart. You can see here that we have a very wide divergence between the K and the D on the stochastic. Now, the percent K is the actual stochastic calculation, and the red is the percent D, which is the moving average of the K. I don't want to get too technical there, but when you see a wide divergence between those two lines, which, by the way, is the widest we've had in 3 years, that tells us that the market is overbought or overextended. Some might even say overvalued. In addition to that, you can see that we have a very clear resistance area at the top from back here in October. So as the price is moving up, we want to pay very close attention to what happens on volume, especially on the daily charts. And you can see, again, as I zoom in, the volume has been increasing on the way up. Now, not to be confused with my long-term downside bearish bias, I still think the volume is telling us we could go a little bit higher. And then I think later in the week, we're going to start pulling back to fill this gap that was left that I am now labeling a blowout gap. This is a breakaway gap. This is a runaway gap. This is an exhaustion gap. This had not been labeled in any way, so I'm labeling it now. And over the past couple of weeks, I'm calling that a blowout gap. And we are also looking for a drop in volume. So I'm going to forecast a drop in volume next week that will lead us into that area of, oh, the buyers are starting to slow down. We'll see. But I do believe that volume drop will be something that shows up earlier in the week. And then we'll start to see possibly some profit taking, some pullback, and then we'll have to see what happens with this moving average. But there's a lot of variables that we have to pay attention to coming into next week because with it being the first full week of trading in the last month of the year, we could see maybe a little bit more of a push for the year end because many people misinterpret what the year end rally is. It's only a 7-day window, but people are going to try to jump in there on that bandwagon ahead of what might be the Santa Claus rally that a lot of people are expecting. So that is DIA. Now, if I look at IWM, you can see we have a big green candle that is a bullish engulfing. Remember, on my trading checklist, that's one of the checkpoints there. Bullish and bearish engulfing candles are right at the top of the list right there. So we do have a bullish engulfing, and we do have that on higher volumes. So next week, again, I think IWM could go a little bit higher. I'm doing a 4-part forecast here, actually. I then think we'll see a drop in volume. Then I think we'll see a pivot on the CCI. And then I think we'll see the price drop from there. I think we're going to give back most of what we gained here today, probably early in the week. Again, that's a big probability depending on how much enthusiasm the bulls have and whether or not they're going to be taking any profits. Now, backing out I want to show you that the weekly chart still has some room to go before we hit some resistance. There's a resistance point up here from August that is up there right around 191 to 192. So we have a little bit of room before that hits resistance. But again, all eyes are going to be on what happens with the volume down there. Now, as we look at the past history of price targets, I just want to zoom in here just a little bit, because I know there are some folks that are watching the markets and they're saying, boy, these charts certainly don't work anymore. Well, I would beg to differ on that, because they work just fine. They are giving us signals. We basically weigh the evidence between the buyers and the sellers, and then we make our forecasts accordingly. Now, if you go back, I'm going to circle all the areas of past targets. So you can see this target that was set hit. This target hit eventually, and I'm going to get to that in a moment. This downside target hit. This upside and downside target hit. Downside hit. Downside hit. Upside hit. Downside hit. Here we had an upside and then another upside target hit. The eventual drop in and then pullback hit. Upside target hit. Downside target hit. We had an upside target that blew through it. This has not yet hit. Now, with the exception of my forecast going into next week, that is 15 out of the 16 targets that were set have hit. So before you give up on the chart, you have to understand that according to my records and the programs that we're using to track price targets, on average, all targets, and I'm talking about equity forecasts as well, on average, 66 trading days are usually the max of what we're looking at for hitting targets. This is very close to a 60-day stretch before that target was hit. Now, we're already into about 10 to 15 days of the most recent stretch before the most recent target is hit. Let me just get rid of all these lines here. And so there's still time for that target to hit, and I have not lost sight of that target at all. Now, in addition to that, before I get into the cues, I want to show you another slide. This is a 14-year record of all of the equity publications that I put out since 2010. These are year-end results with regard to percentage of accuracy. Now, please do not misunderstand me here. This is not a record of returns on investment. It is a record that shows the percentage of times when the price has moved to a target or in favor of a trade that was posted in the publication. I'll say that again. This is not a percentage of returns on investment. That's a whole different story, especially for those option traders out there. Now, the running record is over 81% accuracy. The programs that we're using, thanks to one of our members who has a proprietary program that measures the percentage of accuracy, he's over 80% on his forecast, and that's with all of the equity trades that I put out on a Wednesday, and he too is looking at about 3 months or 66 trading days with 20 days in each month. So if you're trying to day trade according to any targets that you're setting on the chart, and if you're not using risk management to back that position up or to reduce the risk on that position, then I say you're making a very big mistake. This is a time right now for me to go into overdrive for promoting the 1% rule for managing risk. Understand this is a simple math formula that will help you manage risk, and I'm going to highlight the title of this video so that it's easily found on YouTube if you want to go back and listen to it again. But basically the 1% rule is simple. You take 1% value of your account and you set a risk per share, which is basically the buy price minus your stop price. So if you have a stock that you're buying and you put a $2 stop below that, your risk per share is going to be 2. So you divide your risk amount, which is the 1% value of your account, by the risk per share, and that's going to give you the proper size of the position. A big mistake that many people are making is if they go short on an equity, they're not putting a buy stop in, or they're overtrading their account because they're looking at how much money they can spend on that position, and then it gets away from them. Properly sizing the position using the 1% rule is part of the formula. It keeps you in check so that you're not suffering a catastrophic loss. If I see comments in the comment field that say something like, oh, this market is destroying me, then that tells me that risk management is not being applied. And I cannot overemphasize the importance of risk management, especially now. So those are my targets for IWM in the week ahead. If I look at QQQ, this is going to be a little bit different because while we do not have a drop in volume, we also do not have a bullish engulfing up here. Let me show you. Okay, we actually have a lower high but a higher low. That's a half signal. It's not a complete pivot point, but the drop in volume today tells me that we could go lower, and that's exactly where I'm going, into the upper end of this gap fill region here. So my downside target for QQQ next week is 383.27. Now looking at SPY, this is the S&P 500. Obviously, it's the ETF that tracks that. Again, you can see all of the targets that were hit. Here's one it took a while to hit, but it hit. That hit. I don't have to do this. These are all targets that were hit. You know, this is during the winning streak, right? Every winning streak comes to an end. You have to plan for that, manage risk accordingly. This has not hit, and I say with a big capital Y, not hit yet. I'll get to the geopolitical and economic news in a little bit that explains why I'm still holding that long-term bearish position, but that is something you have to keep an eye on. So next week, I do think we're going to go a little bit higher up to that resistance, drop in volume, and then a pullback. So here's another one, a 4-part forecast. Actually, let me do this sideways because it'll be easier to see through the red candles as they start to show up. Okay, so I'm going to forecast the drop in volume either Monday or Tuesday. So again, higher on Monday, drop in volume either Monday or Tuesday. Then I think we're going to see the pivot starting to show up on the CCI, and then ultimately the downside target of 450.18. I guarantee you, there is no one in the world. I know this sounds like I'm bragging or boasting, and I'm not. I'm just trying to emphasize the importance of charts and how accurate they are when used properly. Remember, they're not 100%, but I also say there is no one in the world that's going to give you a 3 or 4 or sometimes 5-part forecast. I'm going to just throw this out there as a little bonus. CRWD, some of our members have a position on this one, and Wednesday I put out a 5-part forecast. Let me zoom in a little bit more. I put an upside forecast right there. We hit that yesterday, by the way. Remember, this was Wednesday. My upside target was set on Wednesday before these candles were around, and that upside target was at 237.33. We hit that. Then I forecasted the drop in volume. Look how accurate that drop in volume is. Then I said the CCI would pivot. There it is. It pivoted. Today we got the hinge forming on the stochastic. So 4 out of those 5 targets have been hit. The only thing we're left with is the downside target at 220.64, which is most likely going to bring it back closer to that gap fill point. I'm using that as an example, not as a trade advisory or anything like that. I'm just telling you that on Monday, our members talked about this as a possible option candidate. And then on Wednesday, we did this again to reiterate the importance of doing forecasts such as this, where you go up and down with your price action. Those are known as pivot forecasts. And then you can go ahead and trade and apply that 1% rule for managing risk. Now, getting back to SPY, and then I'm going to talk a little bit about the VIX. That upside target, again, to reiterate, is going to be 460.58, and then ultimately downside 450.18. Now, let's talk about the VIX. It dropped again today, not as low as where it was last week, but look, you have a positive divergence again. Look at how the stochastic is heading higher as the VIX is still hovering around these lows. That's a positive divergence. I'm not moving that because remember, the VIX is an oscillating index that works for the most part inversely to the S&P. Now let's go to the economic news. This came out a couple days ago on the 27th. Consumers are using buy now, pay later. You could call that layaway. You can call that credit cards, whatever it may be. But this is according to Bloomberg. They're tracking that very carefully. That tells us that the consumers are running out of cash. They're tapping into their savings account. They're tapping into their retirement accounts. We talked about that last month. And again, that is a negative sign. Remember, you can still take bullish positions short term. Remember, this is the percentage of accuracy that I was talking about, but what I did not highlight is that over 90% of the publications that I put out over the last 14 years were short-term buy candidates. They were long positions. So when everyone thinks, oh, I'm the perma-bear that won't give up, I do take long positions. You could ask any of our members. In fact, right now, we are currently long the energy and oils. Can't give too much of that away because those are paying members that get those details. But you can take long positions even if your long-term bias is bearish, because that actually keeps you on guard. Because if you're going to take a position, a long position, but you know ultimately the markets are going to pull back or we could see an economic collapse, what does that do? It helps you be more protective of the long position, and it also helps you take profits so that you don't let those profits get away from you. So it's actually healthy in my mind to be long-term bearish, take short-term longer positions, mix that up with options, and you have a good time of it in position trade. Otherwise, you get stressed out and the markets get to you and start messing with your head. I'm telling you, you got to be careful. You got to protect your attitude. You got to protect your outlook. You got to protect yourself from watching the news all the time. That's one of the reasons why I don't watch financial programming. I'll go hunt for the news rather than having it jammed down my throat. Anyway, here we go. Another one. This was kind of shocking. $40,847.18. That represents a number that shows that half of all American workers make less than that number. That absolutely shocked me. I thought it was a lot higher than that, but then I looked down at the print. You can see $3,400 a month. I really don't know how people are doing it, because that is a before tax number, not a net after tax number. So I don't know how Americans are doing it, but those are the kinds of things that throw us into recession. Another leading indicator is boat sales. Believe it or not, boat sales right now, both new and used, are showing the worst track record in a decade. That is a leading indicator from Bloomberg right there, thanks to the National Marine Manufacturers Association. That was another one that surprised me, because living in Florida, everyone seems to have a boat, and I don't really see too many people looking to sell boats. I see a lot of people holding on to their boats. But then again, I don't really know when people are buying their boats either. I see a lot of boats in the water, of course, but I don't see the for sale signs, and I certainly don't see them going to the bank to take out loans for these boats. But I thought that was an interesting bit of economic information to put out there. This one, I mean, it's not funny, but it is funny. I mean, think about this. These are the Ram pickups, the electric vehicle pickups that the government seems to be pushing out to the public in their green energy initiative. They're putting gas-powered generators in the back so that in case the battery runs out, you have a way to charge yourself up and get to where you're going. All right, next. This was a big one. The U.S. banks continue to bleed in unrealized losses. See, they cannot take the loss right now. So what's happening is the Treasury and the way the Fed governors are looking at this is they're kind of kicking this can down the road. So they're marking their assets at maturity dates. And so they're carrying these huge unrealized losses that actually prevent the banks from going out there and making loans. And if you know what makes our economy go round and round, it's credit. If the banks can't loan money to the small businesses, guess what? They don't get the loans and the businesses don't grow. And that's a big problem, especially when you're looking at the credit situation in our country. I'm not going to get into the U.S. debt clock. We covered that in detail last night, but go to usdebtclock.org and you will get dizzy looking at some of the numbers. What's happening is the tax revenues are dropping while government spending is going up faster than the revenues being taken in by our government. So this is a big problem. I think we're going to see this all come to a head in January. But like I said before, my long-term outlook is extremely bearish. I'm not shy about that at all. I am not an apologetic, as many of you know. I just have a long-term outlook that brings me to the March 2020 lows, and I believe that the event that will eventually bring this market down, like I've said so many times, because I tend to repeat, the redundancy is actually by design, that the event that will take place will be shocking. If I'm wrong, that's okay. We'll still make money. As long as you're protecting yourself using the 1% rule, you will not subject yourself to a catastrophic hit. If you're not using risk management, again, I'm strongly suggesting that you do. But if you don't, then you are subjecting yourself to a catastrophic hit. Thank you so much for watching. Please go to the bottom corner and click on that subscribe button. Subscribe and you'll stay in touch with us and you'll get notifications from me when these videos come out. Stay also tuned in to my Twitter page. I put my live SLV trades on there. I've been tracking that. And you can follow along with me, ghost me, trade along with me, whatever you like. But I put that on Twitter, and I really enjoy doing these videos for you. I hope you like them as well. Have a good weekend. So long.